What if I told you that while most of the world was distracted by Christmas shopping lists, family dinners, and holiday travel plans, a carefully coordinated financial operation was unfolding behind the scenes? What if I told you that in the quietest trading hours of the year, when liquidity is thin and attention is low, some of the most powerful financial authorities in the United States moved simultaneously to halt a price movement they could no longer control? And what if I told you that despite the precision of their timing, the mathematical sophistication of their strategy, and the sheer authority behind their actions, the plan is already showing signs of failure? This is not speculation. This is not rumor. This is not social media hype. This is a documented sequence of regulatory actions, released within hours of each other, executed at a time when market participants were least capable of responding. And the target of this operation was not a stock, not a cryptocurrency, not a speculative tech sector. It was silver, one of the oldest, most foundational markets in human history. In the early hours leading into Christmas Eve, something highly unusual occurred. Between late Tuesday night and the early hours of Wednesday morning, 3 separate regulatory bodies issued emergency measures affecting the silver market. Each announcement on its own would have been significant. Together, released in rapid succession, they formed a coordinated pressure campaign designed to force selling, trigger liquidations, and abruptly reverse a powerful price trend that had been building momentum. The timing was not accidental. The sequence was not random, and the consequences extend far beyond a single trading session. This story is not just about silver prices moving up or down. It's about control. It's about who dictates price discovery in modern markets. And it's about what happens when the physical reality of supply and demand collides with a financial system built on leverage, paper promises, and regulatory authority. Let's walk through exactly what happened, step by step, minute by minute, and dollar by dollar. Because once you see the structure of this intervention, its intent becomes impossible to ignore. The first move occurred at exactly 11:47 p.m. Eastern Time on Tuesday night, just hours before Christmas Eve. At a moment when most traders had already logged off, when desks were empty and decision makers were unavailable, an emergency notice was issued by the exchange that governs the largest derivatives marketplace in the world. Effective immediately, margin requirements on silver futures were raised by an astonishing 75%. To understand why this matters, we need to translate that into real-world consequences. A margin requirement is the amount of money a trader must keep in their account to hold a futures position. It is not the total value of the contract. It is the collateral required to maintain it. Before this announcement, holding a single silver futures contract required approximately $15,000 in margin. After the emergency notice, that same contract suddenly required more than $26,000. That's an additional $11,250 per contract, instantly. No phase-in period, no grace window, no gradual adjustment. The new requirement took effect minutes after midnight, just as Christmas Eve officially began. If you didn't have the extra capital available in your account, you weren't asked politely to add funds later. You were subject to automatic liquidation. Now pause and think about the timing. This announcement came late Tuesday night, right before a major holiday. Banks would be closed or operating with limited staff. Wire transfers would be delayed. Even well-capitalized traders would struggle to move tens of millions of dollars overnight. That logistical reality is not a coincidence. It is the mechanism. But the operation didn't stop there. Roughly 90 minutes later, at around 1:15 a.m., a second announcement hit the market. This time, it came from the primary regulatory authority overseeing futures markets in the United States. New position limits were introduced for silver contracts, restricting how many contracts any single entity could legally hold. On paper, the number sounded large, but for hedge funds, institutional traders, and commodity advisors who routinely operate at scale, it was restrictive enough to force immediate action. If a firm exceeded the new limit, it was given a short window to reduce exposure or face forced liquidation by the exchange itself, at whatever price the market happened to offer. Again, consider the timing. This wasn't announced during normal trading hours, when liquidity is deep and price discovery is orderly. It was released in the middle of the night, on the eve of a holiday, when markets are thin and volatility is amplified. And still, the pressure campaign wasn't finished. At approximately 2:30 a.m., a third statement was issued, this time from the primary exchange where silver futures are traded. The language was carefully crafted, but the message was unmistakable. Due to extreme volatility, the exchange reserved the right to implement trading restrictions, including the possibility of liquidation-only sessions. In plain terms, this means the buy side could be shut off entirely. Traders could sell positions, but not initiate new ones. It's an extraordinary measure, rarely used, and almost never pre-announced unless authorities want to send a message, and that message was loud and clear. Within a span of roughly 3.5 hours, 3 separate regulatory entities acted in concert, issuing emergency measures that all pointed in the same direction: force selling, reduce long exposure, and stop upward price momentum at all costs. These institutions do not casually coordinate announcements in the dead of night before Christmas unless something has gone very wrong. So what was the objective? To understand that, we need to look at the mechanics of how these actions impact real traders. Imagine you manage a large commodities fund. At the start of the week, silver is trading near $68 per ounce. Based on your research, supply deficits, industrial demand, monetary conditions, you believe silver is undervalued. You decide to establish a long position. You buy 3,000 futures contracts. Under the previous margin rules, you need $45 million posted as collateral. Your fund has $50 million in liquid capital available. You're well within risk limits, conservatively positioned, and comfortable. Over the next 2 days, silver rallies sharply. By Tuesday's close, the price is pushing towards $74.50. Your position shows a gain of roughly $18 million in less than 48 hours. Everything looks strong. Then the email arrives. Margin requirements have changed. Your 3,000 contracts now require nearly $79 million in collateral. You have $50 million. You're suddenly short almost $29 million. You were told you must deposit the difference by the next morning, Christmas Eve, or your positions will be liquidated automatically. What are your options? You can't wire that kind of money overnight on a holiday. You can't count on extensions because brokers are constrained by their own regulatory obligations. Your only realistic choice is to sell contracts to reduce exposure and free up margin. But you're not alone. Every trader who received that margin call is facing the same dilemma at the same time. As the market opens, selling pressure hits all at once. Prices drop rapidly, not because fundamentals changed, but because forced liquidation has been engineered into the system. Stop-loss orders trigger, algorithms accelerate the move, liquidity evaporates, and as the price falls, those who were short silver, those betting against it, suddenly get relief. They can cover positions at lower prices. Losses are avoided. The immediate crisis is delayed. This is the playbook. It's not new. In 2011, a nearly identical strategy was used. Silver surged toward $50 an ounce, and margin requirements were raised repeatedly in rapid succession. Leverage collapsed. Forced selling followed. The rally died. For years, that event has been cited as proof that regulatory tools can always overpower commodity markets. But here's the problem. The market today is not the market of 2011, and that difference is everything. In 2011, the silver rally was driven primarily by speculative leverage. Traders were massively overextended. When margins rose, the foundation collapsed. The current rally is built on something far more dangerous to suppress: physical reality. There's a structural shortage of silver in the global market. Demand exceeds new supply by a massive margin. Inventories are being drained to fill the gap. Industrial users are consuming silver not as a trade, but as a necessity. Raising margin requirements does not create metal. Limiting futures positions does not refill vaults, and threatening trading halts does not stop factories from needing raw materials. That is the flaw in the strategy, and it is why this intervention is already showing cracks. Because when the forced selling hit overnight and prices dropped sharply, something unexpected happened. Buyers appeared. Not speculative buyers chasing momentum, but real buyers with real demand and real capital. The price didn't collapse and stay down. It snapped back. That tells us something critical. It tells us that this market is no longer dominated by paper leverage alone. It is being anchored by physical demand that does not respond to regulatory pressure the way speculative capital does, and that sets the stage for what comes next. Because once forced liquidation runs its course, the only thing left standing is demand. And demand doesn't disappear just because the rules changed overnight. The next phase of this story will determine whether the old tools of market control still work in a world defined by shortages, or whether physical reality is finally overwhelming the paper system built to contain it. And that's where things get truly interesting. When markets reopened after the overnight shock, the expectation among regulators and large short-side institutions was simple: panic. They expected disorder. They expected cascading sell orders, widening spreads, and a price collapse severe enough to reset the entire silver narrative. On paper, the setup was perfect. Thin holiday liquidity, margin calls hitting simultaneously, position limits forcing reductions, the psychological weight of authority looming over traders' screens, and for a brief moment, it looked like the plan was working. In the overnight electronic session, silver fell hard. Prices slipped rapidly, slicing through technical levels that had acted as support only hours earlier. The drop was violent enough to trigger automatic sell programs and forced liquidations that had been waiting just below the surface. Within hours, silver was trading near $70 an ounce, a sharp decline from its recent highs. To anyone watching only price, it looked like surrender. But markets are not just prices. Markets are participants. And what happened next revealed something the intervention planners had either underestimated or ignored entirely. The selling stalled. Instead of continuing lower, bids began to appear, aggressively, not tentative, not algorithmic noise. Real size stepped in, orders that absorbed selling pressure rather than chasing it lower. Within a short window, silver rebounded sharply, reclaiming levels that, according to the regulatory script, it was not supposed to revisit so quickly. That response is the key signal. In engineered crashes driven by leverage removal, prices do not bounce quickly. They grind lower as confidence evaporates and capital retreats. That is exactly what happened in 2011. Once the margin hikes hit, there were no meaningful buyers underneath the market. The rally died because there was nothing fundamental supporting it. This time was different. The speed and aggression of the rebound told us that the forced selling was being met by buyers who were not constrained by margin requirements, position limits, or futures regulations. In other words, the paper market blinked, and the physical market did not. To understand why this matters, we need to zoom out and look at who actually uses silver today and why their behavior is fundamentally incompatible with the tools regulators are deploying. Silver is no longer just a financial metal. It is a strategic industrial input. Every solar panel requires silver. Every advanced electronic device relies on it. Electric vehicles, power grids, medical equipment, water purification systems, all consume silver in forms that cannot be easily substituted. And unlike speculative investors, industrial buyers do not care about short-term price volatility. They care about continuity of supply. When a procurement manager at a major manufacturer sees prices dip because of forced futures liquidation, their reaction is not fear, it is opportunity. A temporary dip allows them to lock in supply at better terms before shortages worsen. And crucially, these buyers are not operating on leverage. They are spending cash, authorized by corporate budgets that dwarf the margin requirements imposed on traders. This creates a structural imbalance in the market. On one side, you have leveraged paper positions that can be forced out by regulatory pressure. On the other side, you have unleveraged physical demand that cannot be shut off without shutting down real-world production. That imbalance is why the rebound happened. And it is why the next phase of the story will not be decided in New York trading hours, but elsewhere. The real verdict comes from Asia. When Asian markets open, they do not trade silver the same way Western futures exchanges do. In Shanghai, Hong Kong, and Tokyo, the emphasis is far more heavily weighted toward physical metal and real delivery. Premiums matter more than futures curves. Availability matters more than charts. So the critical question becomes this. What happens when Asian buyers wake up and see that Western paper prices were pushed down overnight by regulatory force? If they panic and sell, the intervention succeeded. But if they step in and buy physical metal at premiums above Western prices, the intervention has failed catastrophically. Because a widening gap between paper prices and physical premiums is the clearest signal that a market is breaking. And early indications suggest that this is exactly what is happening. Physical premiums in Asia have remained elevated even as futures prices temporarily dipped. That divergence is not sustainable long term. Either physical prices must fall, which requires actual supply, or paper prices must rise to meet physical reality. Regulators can influence the paper side. They have almost no control over the physical side once inventories reach critical levels. This is where the mathematics of the situation become unavoidable. Global silver supply is running at a deficit measured not in millions, but in billions of ounces over time. Annual mine production cannot meet current demand even before accounting for growth in solar, electric vehicles, and energy infrastructure. Inventories that once acted as buffers are being drawn down steadily. Warehouse stocks tied to futures markets are shrinking, and recycling cannot scale fast enough to close the gap. None of this responds to margin hikes. None of this changes because of position limits. The intervention only affects who is allowed to hold paper claims, not who needs metal. And that leads us to a second force amplifying the pressure on prices, the options market. Many participants underestimate how powerful options dynamics can be in commodities, especially when inventories are tight. As silver prices rise, call options move closer to being in the money. Market makers who sold those options must hedge their exposure by buying futures. This hedging is mechanical. It is governed by formulas, not emotion. When certain price levels are crossed, buying is triggered automatically. That buying does not stop for holidays. It does not pause for regulatory announcements. It does not wait for human discretion. When prices rebound after forced selling, the options hedging mechanism kicks back in, often more aggressively than before. This creates a feedback loop. Price rises, trigger hedging. Hedging creates demand. Demand pushes prices higher. Higher prices trigger more hedging. Regulatory intervention can temporarily interrupt this loop by forcing prices down. But unless the underlying demand disappears, the loop reasserts itself as soon as selling pressure exhausts. This is exactly what we are beginning to see. The overnight crash removed weak, over-leveraged positions. It shook out speculative excess, but it did not eliminate demand. In fact, it may have strengthened the market by transferring metal exposure from fragile hands to strong ones. This is the irony of aggressive intervention. Sometimes it accelerates the very outcome it is meant to prevent. Because once forced sellers are gone, there is less supply of paper contracts available to push prices down again. Meanwhile, physical buyers continue accumulating. At that point, the market becomes far harder to control. Now, consider the psychological dimension. Regulatory authority relies not just on rules, but on credibility. Traders must believe that interventions will work. They must believe that resistance is futile. In 2011, that belief was justified. The tools worked. The rally collapsed. Confidence in regulatory power was reinforced. But if this intervention fails, that if prices recover quickly and push higher despite the coordinated strike, that credibility erodes. And once market participants stop fearing regulatory actions, those actions lose much of their effectiveness. This is why the coming sessions are so critical. If silver stabilizes and holds above key levels after Christmas, the message to the market will be unmistakable. The old playbook is losing power. At that point, behavior changes. Traders become less willing to sell dips. Physical buyers become more aggressive. Options positioning shifts in anticipation of higher prices. And the pressure on inventories intensifies. This is not a gradual process. It accelerates. Because silver is a small market relative to global capital flows, it does not take enormous sums to move prices once supply becomes constrained. A relatively modest increase in investment or industrial demand can overwhelm available inventory. That is why the regulators acted when they did, not because silver had already broken the system, but because it was getting close. The overnight intervention was not a show of strength, it was a sign of stress, and stress responses often reveal more than calm ones. As we move forward, watch the spreads, watch physical premiums, watch inventory reports, watch how quickly prices recover from engineered dips. Those indicators will tell us whether this was a successful suppression or the beginning of a loss of control. Because once a market transitions from being driven by leverage to being driven by necessity, the balance of power shifts permanently, and silver appears to be crossing that threshold. The next phase will determine whether regulators can still impose order, or whether physical reality is about to reassert itself in a way that cannot be managed with midnight announcements and emergency notices. That decision point is approaching fast. As the market digests what happened during those quiet holiday hours, the narrative begins to split into two very different interpretations. On the surface, officials can point to volatility and say the intervention worked. Prices dipped, leverage was reduced, order was restored, at least temporarily. But underneath that surface calm, a much deeper tension is building, one that does not resolve itself with press releases or emergency rule changes, because markets ultimately do not answer to authority. They answer to scarcity. The silver market is now approaching a point where every additional ounce demanded must come from somewhere real. It must be mined, refined, transported, and delivered. Paper mechanisms can delay that reckoning, but they cannot erase it, and the more aggressively those mechanisms are used, the faster confidence in them deteriorates. This is the paradox regulators now face. Every margin hike removes weak hands, but it also concentrates ownership among those least sensitive to paper market pressure. Every forced liquidation transfers exposure from leveraged traders to cash buyers. And every artificial dip teaches the physical market that waiting pays off. Over time, that behavior compounds. The people who panic are gone. The people who need the metal remain. This is why the true battleground is no longer price alone. It is delivery. At some point, holders of futures contracts will test the system. They will ask for metal instead of rolling positions or accepting cash settlement. And when that happens at scale, the imbalance between paper claims and available inventory becomes visible to everyone. That is the moment regulators fear most. Because once delivery stress becomes public, perception changes instantly. Futures markets are supposed to guarantee performance. The moment participants suspect that delivery might be delayed, rationed, or substituted with cash, the purpose of the market itself is questioned. And trust, once lost, does not return easily. This is not theoretical. We have seen versions of this play out in other commodities and financial instruments. When physical constraints tighten, paper structures adapt, sometimes violently. In silver, the risk is amplified by the market's size. It is small enough to be overwhelmed, yet critical enough that demand cannot simply disappear. That combination is unstable. Now consider the position of the banks. For years, large financial institutions have acted as intermediaries, market makers, and liquidity providers in silver derivatives. They profit from spreads, hedging activity, and structured products. But many of those positions rely on the assumption that silver remains plentiful enough to settle imbalances quietly. That assumption is weakening. As inventories decline, the cost of maintaining large short positions rises. Risk managers demand tighter controls. Capital requirements increase. The margin hikes we just witnessed are not only aimed at traders, they are also a reflection of stress within the system itself. Raising margins protects clearinghouses. It reduces the probability of default. In other words, it is a defensive move. And defensive moves signal vulnerability. This is why the intervention feels different from past episodes. It is not confident. It is urgent. And urgency often means the window to act is closing. The next stage in this process is psychological capitulation, not from buyers, but from sellers. At some point, those who have been supplying paper silver to the market will reassess the risk. They will ask themselves whether the reward justifies exposure to a market where physical delivery is increasingly uncertain and regulatory actions are becoming more aggressive. When enough participants reach that conclusion, liquidity on the sell side dries up. That is when prices stop responding to suppression tactics. Because suppression only works when there is something left to suppress. Now let's bring this back to the broader implication, because silver is not isolated. It is a case study. What we are witnessing is a stress test of the modern financial system, its ability to manage physical scarcity with financial tools. For decades, this approach worked because supply chains were flexible, inventories were ample, and demand growth was predictable. That world is gone. Energy transition, geopolitical fragmentation, and underinvestment in mining have changed the equation. Physical resources are no longer abundant buffers. They are strategic constraints. Silver sits at the center of that shift. If regulators fail to contain silver, it sends a signal to every other resource market. It tells participants that physical reality can overpower paper control. That realization does not stay confined to one metal. It spreads. That is why this moment matters. The overnight intervention was not just about stopping a rally. It was about preserving a model where price can be managed through rules, leverage, and timing. A model where volatility is contained before it exposes deeper problems. But models break when inputs change. And the input that has changed here is availability. You cannot regulate supply into existence. You cannot legislate inventories higher. You cannot margin hike your way out of a shortage. At best, you can delay recognition. And delay has a cost. Every week that passes with tight supply increases pressure on industrial buyers. Every month that inventories decline raises the stakes. Eventually, someone will pay almost any price to secure continuity. When that happens, price discovery becomes unavoidable. This does not mean silver will move in a straight line. Volatility will remain extreme. There will be sharp pullbacks, engineered or otherwise. Headlines will fluctuate. Confidence will be tested repeatedly. But the direction of pressure is set by fundamentals, not announcements. That is the lesson history teaches again and again. In the short term, authority can influence behavior. In the long term, necessity wins. The overnight Christmas intervention will likely be remembered as a turning point, not because it succeeded, but because it revealed limits. Limits to control, limits to leverage, limits to paper promises. Whether those limits are crossed next week or next quarter is impossible to predict with precision. But the trajectory is clear. Silver is no longer behaving like a purely financial asset. It is asserting itself as a physical one, and physical assets follow different rules. As this story continues to unfold, watch not just the charts, but the reactions. Watch who buys dips. Watch who refuses to sell. Watch where premiums persist despite paper weakness. Those signals will tell you far more than any emergency notice ever could. Because beneath the noise, the market is speaking clearly, and it is saying that this conflict is between paper control and physical reality is far from over. In fact, it may only be beginning. Stay alert, stay analytical, and understand that what is happening here may shape not just the future of silver, but the future of how markets handle scarcity in a world where there is no longer enough of everything for everyone at once. This was not just a holiday event, it was a warning. And the next chapter will be written not by regulators, but by reality itself.